Hello and welcome. I'm John Weber. I'm pleased to have with us in the studio today Howard Mills. Howard is the Chief Advisor for Deloitte's Insurance Group. Sam Friedman. Sam is Deloitte's Insurance Research Leader. And Rebecca Amoroso. Rebecca is the Vice Chairman and U.S. Insurance Leader for Deloitte. Rebecca, we're going to start with you today.
Okay.
What should insurers be looking at in 2013?
Well, it's a tale of two markets, same economy, different impacts. For P&C, the outlook is more positive than on the life side. We're seeing improvements in the auto and housing market, which is a good thing for the P&C industry. We're also seeing an increase in rates, finally. Companies are being able to secure rate increases, particularly on the commercial side. And because of that, the P&C industry should be able to weather the storm reasonably well. On the life side, a little bit more challenges because of we've been in a period of prolonged low interest rates. Certainly impacts the types of products that the life industry offers. They are rethinking guarantees that are associated with some of the products, and low interest rate is causing certain annuities to be less desirable for the consumer. In addition to that, because of the slow economy and the high unemployment rate, some consumer spend is down, discretionary spending is challenged, and the consumers in general have a lot of other priorities, and life insurance and annuities is not one of the, it's important, but it's not one of the top priorities for the industry. So they have to do a little bit more work ahead of them to weather the storm.
What about mergers and acquisitions? Sam, is this going to be a big year for M&A?
Well, we do see an acceleration of deals going forward this year. We don't expect any mega combinations going on where you have two huge carriers combining forces, but we do see a lot of opportunity for bolt-on acquisitions where companies that are challenged to achieve organic growth try to leapfrog the competition a bit by either increasing their market share within a core business unit where they think they really have an opportunity to make a profit, or better yet by expanding into either new product lines that they've targeted or even new geographic areas, both here in the United States, where we have emerging markets within our midst. The recovery is not equal across the country. There are a number of states, particularly with energy resources, to leverage that are seeing much faster growth, lower unemployment and such. But of course, outside of the United States, both in Latin America and in Asia, you have a number of countries where growth is faster than here in the United States, and more importantly, where there's a growing middle class that's hungry for insurance products. So, with the opportunities that are out there now, there's some excess capital in the business that could be absorbed through mergers. There's some opportunity to deliver a better return on capital if they can concentrate a bit. So we do foresee heightened activity in the year ahead.
Now, from an operational standpoint, Rebecca, what should insurers be focusing on?
Well, I would say that there are two key enablers to operations. One is technology. I would say probably technology is the one spend. Companies are trying to cut costs as much as possible, and I would say technology is the one spend that is not decreasing. It's either staying level or increasing. There's a lot of activity for the insurance industry to upgrade legacy systems. But more importantly, they're starting to look at some of the more emerging technologies and making investments in those. And we see things like social media and mobile apps being used to better connect with their customer. We see the use of cloud computing as a way to not build everything on their own, but get to a solution quicker at a lower cost. And we also see companies spending a lot of time on their website, making sure that their websites are user-friendly to the outside user. So that's the first enabler. The second is talent as another key enabler to operations. And it may not feel like it in today's unemployment market, but we are feeling the effects of a talent crisis. And what we're hearing from many of our clients is that they're having difficulty in finding people with the right specialized skills that are required today and going forward in the future. And so that's why many companies are recognizing this, and they're starting to focus more on recruiting, retaining the people that they want to retain, and developing and training the people and the skill sets that are required. The other thing that's interesting is we're seeing, the population is becoming more diverse, the workforce is becoming more diverse. the candidates that companies can choose from, they're going to have to make choices and try to attract the best and brightest from all different diverse populations. And so we're seeing a re-energized focus on diversity initiatives and women's initiatives, as an example. We're also seeing companies start to take seriously work-life balance issues and flexibility programs as another way to be attractive to the talent of the future.
Now, what about regulation? Howard, you're a former regulator. What are the challenges in the year ahead?
John, where to begin? The insurance industry is in a very difficult regulatory environment. There still remains a great deal of uncertainty. I mean, I was sitting here with you talking about this issue a year ago, and much of what I said then I could still say today. We're still waiting for the long-awaited report from the Federal Insurance Office. That is going to be something that's going to be very closely watched by the industry. There is now a change, I think, in expectation, whereas a year ago people thought it may not be too harsh on state regulation. Director McGrath, after all, is a former state insurance commissioner. But now I think a lot of people won't be as surprised if it's a little harsher in its assessment of the state regulatory system. I think people are almost expecting a push for the feds to get more involved in regulation. So that sets up the potential for a dual regulatory environment with the states and the feds competing, and that's probably the least desirable environment for the insurance industry. Make it very, very difficult to remain compliant, increase the risk of getting into trouble, the attendant reputational risk that comes with that. So you have the general environment itself, uncertain, expected to become more difficult. And then you have a whole host of very technical regulatory challenges coming down. The ORSA, Own Risk Solvency Assessment. Every company over $500 million in direct written premium as of January 1, 2015 will have to file with their state regulator their own risk solvency assessment. It's a very holistic, very personalized assessment of the risks that that company faces. And one of the challenges that insurers are having in preparing for the ORSA is that the guidelines that they're getting from the regulators are deliberately not very prescriptive. It's very vague. This is part of the regulator's intent to force the companies to really think this through. So, you know, they're just challenged with what it should look like. And then you have international pressures, and basically all the international, all the state, the federal regulatory pressures, you can boil them all down to much greater scrutiny over capital. I mean, the industry is very concerned about having more restrictions on their use of capital, how they can deploy that capital. That obviously impacts everything that the company does, and a laser focus on risk management. Whether enterprise risk management or the ORSA, the risk management is changing everything from the composition of the boards to the creation and the real need to have a chief risk officer in the companies.
Let's talk a little bit about marketing. Sam, how do you think insurers should be marketing themselves, or what should they be looking at in the year ahead?
Well, with the challenges in growing organically, we're going to see more carriers, I believe, taking risks and expanding either their distribution options, their product lines and such. For example, in property and casualty, we think one of the big things that are coming is the notion of selling small business insurance products direct to consumers without agents or brokers either shopping for the client or advising them about the purchase. We've seen this obviously developed in personal lines over the years. It is not a factor right now in small commercial insurance, but in a lot of ways the small business consumer is very much like the personal lines consumer. The products are very commoditized in some ways. The premiums are fairly low, so there's not a lot of incentive for agents to provide a lot of value-added service. And it seems ripe for a transition over to a direct delivery system. We've done some research in this area and are continuing to do so, and it's showing some appetite for this going forward. On the life side, however, there are some opportunities despite the challenges that the industry faces with low interest rates and delivering on the guarantees they're promising. By trying to expand the prospect base for their products. Some of this may be going after Generation X. The Gen X crowd right now is very underinsured in terms of life insurance. They're sort of primed for marketing and educational material to at least enter the market. It might just be protection products at first, but there's certainly the opportunity to build on that down the road into more sophisticated products and services. There's also the opportunity to expand the industry's footprint in the retirement savings and income market. It's no surprise, I mean, there's tons of studies out there to show that This country, it's one of the big challenges in terms of preparation for retirement. There's been a lot of money spent on marketing and such to try to reach these prospects, but there's been a fundamental disconnect among many that either aren't setting aside a plan for their retirement or aren't executing it. And we feel that, that the key to this may be more holistic financial planning, not looking at retirement in a vacuum, but taking it into account among a variety of financial priorities, whether it's credit issues, college financing, home mortgages, and the like. So those are just a couple of the areas where companies may be trying to expand their premium base by going after new types of markets.
I want to ask each of you, in 30 seconds or less, what's your best advice for today's insurance CEO? Howard, why don't we start with you?
I would go back to something I said earlier, and that is to really look at your risk management function. The regulators are very, very focused on that. Other very important stakeholders like the rating agencies, the investor community, and things like the ORSA, the Own Risk Solvency Assessment, done properly can actually help them to run their business better.
Sam, your best advice?
My best advice is that you should challenge everything you do at this point and take nothing for granted. Sometimes the tendency is to circle the wagons and just try to hold on, wait for a rising premium tide to lift all boats. I don't think that's ever really going to work again. People need to do a fundamental reassessment of their distribution systems, their product lines, their marketing strategies, and do whatever they need to do to shake things up and to reach more consumers in the way they prefer to be sold as opposed to how you prefer to sell to them.
Rebecca, you get the last word today. What's your best advice for CEOs?
My bet is on technology. Technology is changing the way we do business today, and I think the insurance industry historically has been a laggard in technology, and my advice is to stay on top of and be more cutting edge around technology, and it's the best way really to attract the consumer of the future who's going to be more and more technology savvy, and it's also a way to attract new talent to your organization.
Rebecca Amoroso, Sam Friedman, Howard Mills, thank you so much for taking the time to speak with us today.
Our pleasure.
Thank you.